In today's video, be diving into Hong Kong's property market, where there are signs of life after a nearly 30% collapse in home prices from their 2021 peak. We'll be analyzing data from the latest reports and economist forecasts to see what's going on and what the future might hold. So if you're ready to get started, let's dive in. Alright, so first off, let's take a look at some recent developments in the Hong Kong property market. According to Let's Get Checked Out, a local property agency, prices in May and June did unbudge much, holding steady month to month, but still remaining near their lowest point since 2016. Now that's important because it shows that despite the significant drop from the peak, prices have continued falling, even when the broader economy has shown signs of stabilizing. What's more, they are now at their lowest level in 8 years. In terms of monthly changes, the average price per square foot fell just 0.2% month on month, but dropped 6.5% year on year. The most notable declines were in the luxury sector, with prices plummeting 25.5% below their 2021 peak. On the other hand, mass residential homes are down 18.3% from their peak. Now, this is a really important point because it shows that the pain is not limited to just high-end homes. It's affecting the entire market. But perhaps the biggest game changer has been the sharp plunge in HIBOR, Hong Kong's benchmark interbank rate. Remember that interest rates are a major factor in the property market because they affect how much people can borrow and therefore how much they can spend on homes. Well, over the past year, the 1-month HIBOR has fallen dramatically from over 4% to near or below 1%. That means borrowing costs are significantly lower than they were in 2022 when the market was heading towards its peak, and this has helped to fuel a wave of renewed interest in home buying. In fact, data from Centilene, another local agency, suggests that in Q1 of 2025, new home sales surged by over 35% in units and 16% in value compared to the same period last year. The secondary market also saw a rebound, with volume rising by 19% and value increasing by 14%. To me, this indicates that there is still a lot of demand in the market. Buyers are becoming more active, and they are finding attractive deals thanks to the lower interest rates. However, many market observers remain cautious. In a recent survey by South China Morning Post, more than 70% of respondents said they felt that buyer sentiment was still weak due to concerns over the global economy, lingering US-China trade tensions, and worries about their own financial situation. That's right. Even though interest rates are low and prices are falling, people are still not confident enough to make big purchases. They are being very careful about their finances, and they want to be sure that they are making the right decision. Now, let's shift our attention to the commercial real estate market. Here, the outlook is even more challenging. Despite the residential rebound, Hong Kong's commercial property market is expected to continue suffering this year as businesses tighten their belts amid the ongoing economic uncertainty. We've already seen signs of trouble in the office market, with rents expected to fall by 5 to 10% and vacancy rates rising. Retail rents are also forecast to drop by 0 to 5%, with vacancy rates climbing above 10%, and the industrial sector is not immune either, with rents projected to slide by 5 to 15%. One of the main drivers behind the weakness in the commercial market is the lack of demand. Many companies are downsizing their office spaces or moving to more flexible work arrangements, which reduces their need for physical office space. The economic slowdown is also hurting retailers, leading them to close stores, and landlords are scrambling to find new tenants. Now, why is this happening? Why are companies suddenly downsizing and closing stores? Well, it's because of the economic situation. You see, the global economy is facing a lot of challenges right now. There are trade wars, political tensions, and the aftermath of the pandemic that are all contributing to a slowdown in growth. This is affecting businesses all over the world, and it's leading them to cut costs wherever they can. And what better way to save money than by reducing your office space or closing unprofitable stores? Many companies are also adopting more flexible work arrangements, allowing employees to work from home or from different locations. This is reducing the need for large office spaces and is also putting pressure on the commercial real estate market. Now, you might be wondering what this means for investors or for those who are looking to buy property for investment purposes. Well, it means that there are some good opportunities out there, but it also comes with a lot of risks. If you're looking to invest in property, you need to do your research and be very careful about the properties you choose. The commercial market is expected to continue suffering for the next few years, so you need to be prepared for that. You should consider investing in properties that are in high demand and that have a strong rental history. Properties in prime locations that are close to public transportation, shops, and other amenities are usually in high demand. And that means that you're more likely to find tenants and keep your property occupied. So let us take a look at what the experts are saying about the future of Hong Kong's property market. According to Andy Lee, the chairman of Knight Frank, home prices will rise 3% in 2024, driven by improving mortgage conditions and a resurgence of mainland Chinese buyers. In fact, Lee believes that prices could hit a new record high in 2025 if interest rates stay low. Of course, these predictions are based on a number of assumptions, and there are risks involved. The economic situation is constantly changing, and unexpected events can occur. However, these predictions are based on the best available data and expert analysis. BOCOM, the Bank of China's Hong Kong branch, is slightly less optimistic. They believe that home prices will rise by 3% gradually over the next 2 years, before picking up in 2026. But their prediction is largely dependent on the direction of interest rates. As I mentioned earlier, interest rates play a major role in the property market. If rates remain low, then the market is likely to continue recovering. However, if rates increase, then the recovery could be slowed down. JLL Jones Lang LaSalle is even more cautious and believes that a sustainable upward trend will not emerge until 2026. Once inventory levels normalize, they say another risk factor to consider is the availability of credit. The Hong Kong Monetary Authority, the city's de facto central bank, has been concerned about the tight credit conditions in the property market. This is despite the fact that interest rates have come down. The HKMA believes that banks are not lending as much as they should to property developers. This is because banks are worried about the creditworthiness of developers and the overall health of the market. As a result, developers are having a hard time getting the financing they need, which is making it difficult for them to acquire new land and develop new projects. In addition to the economic and financial challenges, there are also social and political risks that could affect the property market. For example, the ongoing protests in Hong Kong have created a lot of uncertainty and volatility in the market. These protests have made it difficult for developers to complete projects on time and have also scared away some investors. Overall, the future of Hong Kong's property market is uncertain, and there are a lot of factors that could affect prices. However, despite the challenges, there are still opportunities for investors who are willing to take risks. If you're thinking about investing in Hong Kong property, you need to do your research and be very careful about the properties you choose. With that being said, I hope you enjoyed the video and found it useful. If you did, please don't forget to give us a thumbs up. Also, feel free to leave any comments or questions you have. Thank you for watching, and remember to tune in for more updates on global markets. Stay informed and make smart investment decisions. Thanks again for joining us, and we'll catch you in the next video.